So moving on to our last topic of this evening, HoneyBun's third quarter financial performance. HoneyBun
Mhm.
is, I don't know, I just like this company. It's a fun company based on what they create. And then the image of their CEO is just so, happy and friendly and makes you want to eat up those nice donuts and cinnamon roll. How did
Yes.
they do this third quarter, Leo?
Yeah, man, they did very well.
Ooh.
This company, they have a track record of doing well. So in this quarter, if I can share my screen here so I can show you what's going on. So in this quarter, what you're seeing is that revenue is up, profit is up. So if you zoom in a bit here, you can see where revenue is up about 9% on almost 10%, and net profit is up almost 44.5% this is in the third quarter only, right? So if you zoom out a bit now and you look on the 9 month period, then you can see that they actually have good performance also. So if you look at the 9 month, revenue is up about 18% and profits up almost 50% over the 9 month period. So they're doing very well on the 9 month period also. And then if you move forward here to, yeah, if you look, zoom out a bit now and you look over the years, right? You're also seeing some good performance from them. So if you look out over the years, you've seen where more or less revenue steadily increased, profits have increased more or less steadily, but you saw like a decline occurring in the most recent year, right here in 2022. Oh, for context, they're here in the September. Now, when you on a slide I'm going to show soon, you'll see that there's some kind of correlation between the performance of the company in terms of profit growth and the performance of the stock. We still see that though. So let me just zoom this out and take a look here so that now when we look at the cash flow of the company, what we're seeing is that the operating cash flow more or less increased over the period. So you see it steadily going up here and dipping in the last year in 2022, from 304 million down to about 184. But a lot of that decline right there is because of increased receivables, which are, of course, are non-cash items. Say, but that's out. So that's the reason why I see that decline there. So it's basically because of a growth in the receivables that they had in that year, why I see that decline. And of course, because profits came in a bit, then that's why I see that decline. But all in all, good for them. And let's move on a bit here now. So now, if you look on just the last 9 months period, you're seeing that they did 308.7 million in the 9 months in operating cash flow. Now that's significant because if you go back here and you look up, take a quick look in 2021 financial year, they did 304. And in this quarter, the 9 month period, they already did 308 million in operating cash flow. So if you just take a quick look what we've seen so far. So we say the income is up. Obviously, some strong cash flow coming in, as in an operating cash flow from them, right? And then now, if we take a look on some of these ratios, we're seeing that the gross margin moving in the right direction. So this is over the most recent 9 months period compared to the same period the prior year, right? We're seeing that the gross margin, operating margin, net profit margin, all of them have improved. The current ratio, that's also up. Now, the current ratio has been well over 1x, one times. So that means basically any near-term liabilities, they can easily meet those, right? And then if you look on the debt to equity ratio, it's basically non-existent. It's basically just some lease liabilities that they have an accounting thing. So basically, this company basically has high cash flows coming in, no debt, strong profitability, and earnings growth, right? And look on the ROE, return on equity, return on assets, those are also strong. All right. Now, if you look on the performance of the stock now, that's a different story. So the stock is down about 21.4% for the year. For perspective, the junior market on a whole is down 2%. So this is a massive underperformance,
Wow.
which is quite unusual because, again, usually when the stock does well, in terms of not the stock, the earnings does well at a company, the stock does well also, but for some reason that's not appearing now. So
I
when you
wonder
look,
why.
I'm not sure what's happening this year in particular. It's kind of weird. I think it's, again, might be tied to the overall sentiment in the market because if you look on this table here, right, it's showing the performance of the stock over the years for each month and for the full year. So if you look on the last column here, 2019 is saw a strong performance, 2021 is saw a strong performance, And if you go back and you look on the earnings of the company, you realize that those years kind of coincide when the profits was up significantly, like over 30%, right? But then of course, 2022 year, we know 2022 was down a bit for them. You see the stock performance was down. Now 2023 looks very strong for them, but the stock performance is still down. So that's the unusual part for them. And this what I call them, disconnects do occur from time to time in the market where the company is performing, but the stock price isn't. And again, we know that the overall market taking a beating, but again, the junior market's down too. This is down 21%.
I'm
So
surprised the junior market is only down too, because I thought it was
yeah,
more than that.
yeah, it was at one point. So if you look on the chart, you'll realize that up to just a little bit before, it was actually down some over that, like over 6+%. So it's just recently probably rebounded why it's just down 2% now. But yeah, it was down. And if you go back earlier in the year, you can see it was down at one point in the charts. I'm not sure if it was. And right here, you can see it was actually down like 10%. If you go back, sorry. If you go back early in the year here, you can see it was down like 10%. But now this is where it's at. So it's not that bad for the market. And you can see again, another way of looking at the stock performance of HoneyBun, you can see that, in the heyday, this is what, late 2021, it was up over $10 a share compared to where it's at now, which is like $6.28 a share. Well, as I close today. So, it's not doing that well there. Now, when you look on the price month, no, sorry, look on the volume on the stock now. So we're seeing that the activity is actually falling off. So 2021, which was a good performing year for them, the activity was very good. You can see the stock trading well over $1 million on an average day. The volume has been declining, and now in 2023, we can see that the lowest that we've seen for all of this, the data here, which is a little bit over $200,000 on an average day. Which is pretty low for the stock. And again, to be fair, some of this might be because of this general decline in trading activity in the market, which we've seen, again, because of overperformance in the market. So investors not really trading as much as they used to, but that's what's going on there. Now, when you look at the PE of the stock, it's very cheap. And you look on how it usually trades. So over the last year, average about 15 times. Now it's trading at about 11 times earnings. And any period you want to look back, about 3 years, 5-year average is trading well below all of those. So it's a sign that on a, comparing it to itself, it is relatively cheap. And again, because of what we looked at before, the question that you have to ask yourself as an investor is, does it deserve to be this cheap? Because again, they're performing, all indications that they can continue to perform. The balance sheet is strong, cash flow position is strong, profit is strong. And there's by all indications in terms of the investments that they're doing, what expansions that they're doing, they're continuing to grow. So the question, if I ask yourself, an investor, and you look at this, is it an opportunity or is it like a value trap? So that's the question when you look on all of this data here. And on a price to book basis, you can also see a similar trend where it's very cheap. So basically that's it. So looking through all of this data here, I know it's a lot. Trying to make it shorter, it's a lot. But looking at all of this
Great
data here,
discussion. Great
yeah,
analysis.
it gives you an idea of what's going on with this company, and then it's down now to the investor to make the ultimate decision. Of course, consult your broker, your advisor, if it's for you in terms of your risk tolerance, in terms of what you're trying to do. There's something I forgot to mention. This also is a very good dividend payout. So the consistently paid dividend while still growing revenues, while still growing profits. And so it's done. It's basically done everything that it can do as a company. So there's nothing really to fault them on to say, boy, they're not generating that cash, they're not paying no dividends, and the dividends have been steadily increasing over time. And again, because of how much cash they have on the balance sheet, I didn't show it here, but the company has hundreds of millions of dollars of cash on the balance sheet, and they generate hundreds of millions of dollars of cash each year. So they're in a position that they can keep paying that dividend for some time and grow, meaning grow organically. The debt level is low, so if they need to borrow in order to help them grow, they can do that also. So there's a lot of avenues open up for them in terms of what they can do. And so that's it. So all in all, I think it's good.
Couple comments on HoneyBun from the viewers. Troyan says HoneyBun recently opened an outlet in St. Thomas as well. So
Yeah.
part of the reason for the increase in revenues. And then
Mhm.
Lily says people moving around shares to take advantage of the dividend payouts keeping this month. But you also just heard Lily say that HoneyBun is also a great dividend paying stock. So could be part
Mhm.
of it. I don't know.
Yeah. Yeah. So it's yeah. So that's it. Mhm.
Natoya said, I guess investors find the stock boring. We don't hear much
Yeah.
about Honeybun.
Yeah, and you can see it in the activity. It doesn't. It's not trading that much. $200,000 on an average day. That's not a lot. So I mean, yeah. So I guess that's it. But the thing is, the way we have asked yourself as an investor, when you're looking broadly, building out your portfolio, is yes. Again, some of the business models might not sound as exciting, like some of the tech firms, like some of the but if the company is generating good operating cash flows, good dividend paying, growth is there. The thing is, and again, clearly you're not going to put 100% of your money on it, but you have to ask yourself, is this something that I'd like to include in the portfolio? So that's how I look on it. So it's not always going to be exciting and flashy in terms of the business operations, but
I mean, sometimes boring companies are good, boring, consistent,
the,
reliable.
the companies, yeah. Mm-hmm.